Recording now.
Fantastic. Well, good morning, everybody. Always a pleasure to be with you on these special Trade Out Loud conferences. It's really a fantastic way to really educate yourself across a lot of experienced traders, and what I always tell people is, you've got to focus yourself on what resonates with you. My goal is to share with you techniques, in this case, more of a stock-based technique that you could trade options on too, on a number of these names, but kind of starting with the stock, and share with you my two favorite, not one, but two favorite stock trading strategies. And these are all about the whole principle of compounding, letting your money build, controlling your risk when it's not working, getting rid of trades, not getting stuck being a bag holder, but actually being able to move your money along to the next opportunity that has the best chance to get you the kind of growth and compounding in your portfolio that we all want. So let's get into it here. Just a reminder as I get rolling that everything I share with you here today is provided based on our proprietary research and is intended only for illustrative purposes. It should not be construed as specific advisory recommendations. Of course, you know that you are 100% responsible for your own trading decisions. Stock and options trading have large potential rewards and also large potential risk. The past performance of any trading system or methodology is not necessarily indicative of future results. Do see our terms of use on our bigtrends.com homepage for more information. So with that behind us, let's get into it. If you don't know me, I've been trading for over 32 years in stocks and options. I caught the trading bug when I was at Duke University, and actually switched majors, realizing, how powerful this this was in the late 80s, like post 1987 crash. Just basically saw just the tremendous movement up and down. And then realized once I learned about options, how you could leverage the stock ideas with options. So launched Big Trends back in 1999, more than 22 years ago. Blessed to be inducted in the Traders Hall of Fame, standing on the shoulders of a lot of other giants. So my goal for you through these sessions is to help you kind of stand on those same shoulders and kind of get the shortcut to kind of both the opportunities that you may be missing, as well as kind of learning about mistakes you've been making and applying your capital to slower boats when you can get on potentially the speed boats that can get you there a lot quicker while still managing your risk. So we're going to go through that, and been blessed to serve tens of thousands of folks over these past couple decades in my various trade alert services and my trade education and boot camp and coaching programs. So what are we going to talk about today? I'm going to share with you the eighth wonder of the world, as it's called, and we're going to show you how you can compound your stock profits properly. And that this involves not applying too much capital to any trade, but also letting your trades have a chance to grow, not getting the hair trigger exit too quickly on things that are working. You want to start to be more patient on your winning ideas and less patient on your losing ideas. So I'll share with you these favorite high growth stock strategies. One's more geared towards blue chips and one's more geared towards momentum and kind of maybe smaller cap growth comparatively. It's also about how you make trading fit your schedule. When I got started, and then frankly, when I started Big Trends in the late 90s, everybody's talking about day trading as the path to wealth. And I was saying, this doesn't make a lot of sense, at least relative to, the fact that you got to get a return, not just on your capital, but a good return on your time. If I spend 8 hours a day trading, I better be getting 8 times the bang for my buck versus if I spend an hour a day in my trading and operation. So the idea is that, to me, that's like, if I don't, then I'm not getting the leverage of that extra time. I'd be better off to use it for leisure or for other areas, family, spending time with kids and grandkids or whatever, and significant others that basically make your life richer in those ways too. So you got to think about your time return, not just your capital return. So we're all about making that trading time minimal after market hours in terms of what you need to do for the next trading day, and not having to be stuck watching screens all day. So we'll give you a lot of chart examples and success stories along the way. So when we talk about the eighth wonder of the world, who better to kind of get a perspective on this than one of the geniuses of many generations, Albert Einstein, who said, that his quote, and the hint is, it's, if you're a stock trader and investor, you should pay extra close attention to his quote. He said, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it, right? So you think about the ways you can earn it. Obviously, we know about investing in the markets, and this goes back to also when you're making money, getting more out of that, continue to ride at least part of your move when it's working, but also not letting that negative wealth effect of losers compound against you. That's paying it, if you think about it in a trading perspective. If you're riding your losers, if you're averaging down on your losses, if you're making those kind of mistakes, you're the one paying it, right? You're basically paying for those mistakes. That's why you never throw good money after bad. We don't want to be the one that pays it. There's too many investors and too many actually traders, short-term traders I know, who became long-term investors because they thought, well, it's Apple, it's a good company, it'll bounce back even if I'm wrong on the short-term trade. And then they buy and ride it down through a down cycle, and then usually bail near the bottom before it rips back up. The idea of how do we make this work for us is to earn it by getting more out of our winners and less out of our losers. It's the same thing with thinking about how you spend money that you could be investing. If you're spending money, for example, building up credit card debt on luxury purchases or other wants rather than needs, that's money you could be putting into your investment portfolio and letting it earn for you. It's that you're paying a credit card company sometimes, outrageous interest rates, right? I see 20% plus interest rates on some of these. By the way, after the trial period is over, card offers that we're all bombed with in the mail, and going, who would sign up for that, right? You've got to be in bad shape to do that. So clearly, part of trading and investing success is also spending less than you earn. So you think about like a Warren Buffett who still drives the same car, lives in the same house that he's driven and lived in for many, many years, and saying, okay, that's another principle to, not having to, kind of raise your lifestyle and thus raise your cost structure compared to putting that excess cash into your investments. Anyway, principle is, let's let that eighth wonder of the world work for us on compounding, not against us. So how do you put the power of compounding work for you and your investments? Of course, compound interest says, does that mean you have to get high dividend yielding stocks? No, not necessarily. The idea is that, if you've got $10,000, you grow it, steadily, just for the sake of course, the principles of, round numbers. Even if you make, say, 20% annualized, you go from 10,000 to 12,000. The next year you don't make 2,000 on your 12,000. You're making, of course, 2,400. So that extra bit is the compounding bit at work. So, and that keeps compounding positively. You're going to keep growing and taking advantage of the power of compound interest and the principle of compounding. To me, stock trading is one of the most powerful ways to use compounding, as I'm going to show you, because as you can see here, 10% of your account to trade. Say you take $1,000 in from a $10,000 account. For us, we're targeting stocks, particularly in my stock doublers program, that can make 100% or sometimes double on a double, up to a 300% gain on the initial money invested. And saying, okay, if we can make it even 100%, that 1,000 turns into 2,000. You've grown your account, assuming nothing else has happened on your other positions. You've gone from 10,000 to 11,000. So your next allocation is actually growing from $1,000 a trade to $1,100 a trade. So you're putting the power of a system that's working into your compounding mode when you're taking just a set percentage of your capital. Of course, if you also have a loser, you might put a little bit less into the next trade. So the goal is that when it's working, it should be actually helping you to add to your capital allocation without getting crazy, while still keeping a sensible no more than 10% allocation in any one trade. And then, when it's in a drawdown phase, it's going to have you put less in per trade by definition. And then that's the key, is that you let your winners run and you cut your losers more quickly with less impact. Obviously, this compounding principle has the power to dramatically change your life when you look at it over the longer haul. But you have to really take the big picture view. So you say, okay, well, you could just buy the index, right? You could just say, well, I just want to track the stock market. I want to, know that I'm going to at least match the market return. And that's why S&P 500 index funds grew to such popular heights, because everybody just kept pouring the money into those. And so that's part of why you've seen this also push into like the FANG names being such an overweighted part of the mix, because it's kind of that go with the winner strategy. But of course, that has the volatility on the downside as well. But the idea is that for us, we're not going to be fully invested. We've had a very heavy cash position in both of our portfolios right now, stock doublers and stock leaders. We'll get into both. But let's look at, for example, stock doublers first. So if we took it back to January 1 of 2017, so about 5.5 years ago now, updated through today, you say, okay, how would you have done in the S&P 500? That's the red line here. You would have grown that $10,000 up to $17,603. That's not bad, right? That's a 76% return over 5.5 years. So you should be, in that neighborhood of probably about a 10 to no more than 12% annualized return on the stock market over a longer period of time. But you can see our stock doublers portfolio started at 10,000 and it grew it to 73,733. So you can see that, sure, it's not a straight up line. Our stock doublers, you can see, had a really strong equity run here, and then you can see it's kind of flattened out here over the more recent samples. But as you know, the market's down this year. The S&P was down 20% plus at its lows. The Nasdaq down more than 30% at its lows from where its peak was at the start of the year. So the point is that sometimes flat can be a really good thing if the markets are down or difficult. So part of it is managing to hold on to the wealth through the down cycles, not just to grow it strongly through the up cycles. So you can see 73 against 17, you're talking about a factor of more than 4 times better than the market. And of course, the dollar amount grown, instead of making $7,600, we've made $63,000 plus. These are gross before commissions, but as you know, with stocks now, you pay no commissions. If you're paying any commissions, switch brokers, right? No commissions on stock trades. So it's an even the best time in my 30 plus year trading career to be a stock trader. So you can see, okay, if you start thinking of it that way, $7,600 following the market, 63,000 plus falling profits following the stock doublers. Obviously, past performance does not guarantee future results. But the idea is that, hey, okay, now you're talking about a factor of what, 8 times more profits off of that. If you think of it that way, that's even twice the bang for your buck than the 4x portfolio size, because you're looking at taking out your original starting $10,000 capital. So that's what I want to teach you about today, is how do you get more of that. Now, with stock doublers, this is more aggressive. This is they're not penny stocks, but they're definitely stocks that are a lot smaller than your typical blue chip, Apple and Microsoft and, Merck and Pfizer and, pick all your Dow stocks out of that mix. We're not dealing with those stocks with this stock doublers portfolio, because those stocks are many billions, if not, pushing towards, trillion dollar plus valuations. It's harder to double a trillion into 2 trillion. So the principle here is that, okay, we say, look, these are a little bit more volatile, so we're going to actually even further lower our available capital per trade to 4% of the capital going into any one stock. That further reduces your risk. It also gives us the ability to get up to 25 growth opportunities in markets that are rewarding, the upside. Frankly, this recent period, we're just starting to get some new signals. I just called out a couple of new trades for my stock doubler subscribers here this week, after being, back to kind of a full cash mode. So that's why I want to talk about this today, because I do think we're starting to see signs of bottoming. Not to say that the bottom is in for equities, but signs that you're starting to see some of these growth stocks pop up onto our radar. So here's why limiting your exposure per trade is so important. You start thinking about what it takes. If you have a loss of 10%, you need a plus 11% to get back to even. That's not much, right? If you took a $100,000 portfolio down to 90 back to 100 means you made 10,000 on your 90 lower base. That's where the 11% comes in. So the problem happens as you start to see these things get away from you too much. At a 30% loss, it takes a 43% to get back. And of course, at a 50% loss of your capital, if you went from 100,000 to 50,000, you would have to go $50,000 in profit to get back to even. That's going to be 100% gain required from 50 to 100, right? So that spread, if you think about it in the amount of points, obviously it's just 1 point spread up here at the top. It's going to what, 13 percentage points spread as you get to a 30% loss. And of course, it's going to 50 if you get from a minus 50 having to go back to plus 100. Of course, it's absolutely unacceptable to think of losing 90% and then having to make 900 and seeing the spread there be some 810 points, right? So that's an insane, almost unachievable type of a comeback that you can't afford to dig yourself out of that hole, both in the odds you're going to be able to make that kind of a huge return to offset those kind of huge losses, but also the time it's going to take. The lost time is so important, especially as we get closer to retirement age. So many of you that I talk to I'm 55, so I'm not that far from that quote retirement age. Although what I look at the markets as is a vehicle to stay mentally active throughout the course of my life and your life, which will help you to actually, I think, enjoy a much longer life by keeping your brain active. And we just have to offset it with keeping our bodies active too, right? But the idea is that make sure you dedicate some time for that. We all need to. But the idea is that, okay, we can stay active and even, just focus on the markets will help us to never have to, quote unquote, retire our brains. That's where people kind of check out. And we don't want that. So the idea is that, okay, look, strong trading investing strategy paired with really solid risk management and taking advantage of the power of compounding is what's let our stock doublers system achieve this massive outperformance against the market. Like I said, 10,000 grew to over 73, $63,000 plus in profit. So this is only putting 4% in per trade. We could actually be even more aggressive and probably show an even bigger gain, but we don't need to. In 5.5 years, if you made 7 times your money, or let's say 6.5 times your money, over that period, you'd be very happy and no need to take excess risk. These stocks are priced at $50 or less per share. So if you're taking, say, a model $10,000 portfolio and saying, well, gee, I can only get $400 going into each trade. Well, that still could get you, typically in the neighborhood of a couple hundred shares per trade. But ultimately, even if I got 80, if the stock's at 50 and I got 8 shares, I should say, at 50, that would only be $400, right? 8 shares. Well, that's fine. It doesn't really matter whether you have 8 shares or 800 shares. What matters is that you've got the right growth profile for the period under question. As we know, past performance does not guarantee future results. So don't assume the future is going to look like the past. It's going to vary. Could be worse, could be better. So we like to think we're green and growing and learning all the time, but of course there's going to be changes in the market. You need to adjust for that. Now, when you think about why trading individual stocks now is never, like I said before, never been a better time to do this, is because the first reason is because commissions are $0 for equity trades. So the beauty of that is that you say, okay, now we don't have to worry about what is happening on our commission side. We have to more worry about, do we have the edge? And if the edge is really in our favor over a longer sample of trades. Even if you've got a really good system with a really good trading edge, you're still going to have losing trades. You never want to load up. You always want to be diversified in your capital allocation and never getting an all-in moment. But the second point here is just as important, which is that the pandemic exposed the S&P 500 index strategy as vulnerable, given that, of course, there were dramatic winners and dramatic losers out of the pandemic. We've seen it on the way up, and here in more recent times, those pandemic winners have turned into, this kind of corrective bear market 2022 losers, the Zooms of the world, with great platform. We're on it right now. But the idea is that, you look at those, you look at, of course, the Netflixes, the many stay-at-home stocks and the tech-heavy beneficiaries in the pandemic when everybody was stuck at home and having to utilize that technology, and even Amazon, how they drove so much additional cost structure to build out for the pandemic growth that they were having. And now they basically have overbuilt and have had to, you're seeing a lot of these tech companies talk about not just hiring freezes, but even layoffs. And of course, excess capacity that's now going to take years to potentially get to full utilization again. So the index principle was really exposed as saying, look, it's a lot better to be a stock picker, get the right stocks in the right sectors at the right time, than to just buy and hold and basically see that, sure, there's winners, but there was also losers from the hotels, the airlines, the various travel sites, and more that were, getting hurt, casinos and the like, getting hurt by the shutdown and the pandemic. Everybody hopes that we're beyond that, but we all know that these mutations oftentimes are even more problematic of these COVID strains. And so, we're still going to see, I think, some cycles on that where you still see some various things pop up and cause some problems in terms of shutting down people's willingness to go out if there's some kind of a surge and some kind of a strain happening. So it's something we have to just kind of deal with. But the idea is that also, you can easily trade these stocks in retirement accounts, so the gains are not taxed until withdrawal. And so you get the benefit of that tax shield to let that compound and keep working for you without the government taking their 20 or 25% capital gain hit off of, depending on what type of a bracket you're in, saying, look, we can make that money work fully for us, not 75% for us after the government bite of taxes. And we all know, based on government deficits and whatnot, that that's only likely to go up in those tax rates over time. So really important to shield it as much as possible. So this is really ideal for more of a position trader. A lot of times when we're talking about options, we're talking about swing trading over a week or less. But here we're talking about oftentimes multiple weeks of letting these positions ride. So let's dive into some success stories. Some of them do happen very quickly. Other ones take more time. So we do call these outlier trades. So you shouldn't expect that every one of these is going to be a doubler and more. But the idea is that those are the ones that carry your portfolio, and we control the risk on the rest. So what do we have here? These are stocks that oftentimes when I find them on my scans and my systems, oftentimes I haven't heard of them, or maybe I haven't really heard of them that much yet. But the principle here is that we use an indicator that when you become a subscriber, we'll give you all the details, all the settings, all that kind of stuff. But an indicator that actually measures, how quote unquote overbought a stock is. And we actually want to see stocks that are starting to go overbought. I call this moving into the orbit phase. If they're moving into this orbit phase, that high, and as it crosses that 100 line there, if it closes above that, which it did the next day for Canberra Energy CEI, this is a low dollar stock. It's about a $2 stock. One of the big things we said is that we've learned the lesson from the early days the hard way, that you shouldn't try to put a limit order in. We say buy at the market the next morning. So we're buying in the market the next morning at $2.26. If we had said put a limit in at 2, and this thing you see races from 2.25 to 4.5 plus over the next couple of sessions, if we put a limit order in 2, we would still be standing at the station with the train having pulled away, and we would be left behind. We did not get a chance to get in at that prior day's close that next day. So when a trend is in motion, kind of like the train's in motion, you need to go ahead and hop on before it goes on without you. So it's worth paying that, in this case, about 10% more to get on the train and say, okay, now you're on that speed train to say, in 2 days, we went from 2.25 to 4.5, sold out at 4.52 on the first half of our position. So we only sell half at a double. We don't sell the whole thing at a double, because our experience is if they're going to keep working, they can go on up to triples and quadruples. So we put a second target in at double on our double. So from 4.5, we're targeting about 9-ish on the last piece. This one didn't get there, but we've got some other rules that will guide you through how to get out if it's not getting onto that final double on a double, 300% gain on your original investment target. But you start thinking about that. If you can get half out at a double and half out at 300%, that averages a triple on your whole position. If you say, well, if you put 4% of your portfolio in and now it's tripled, right? That's like a 12% gain on your one trade that just adds up 12 percentage points into your whole portfolio on an annualized basis, right? So you get a couple of those in a year, that's like 24% gain. And you go, okay, that makes a lot of people's year if the other trades all just kind of scratch out. Obviously, we want even more than that. But the idea is that, it doesn't take a lot of these to make your year. A couple of those good trades makes for a solid year, and 3 or 4 of them in a year makes for a really outstanding year, not to mention the other things that we can do along the way to still make some money, even if they don't get to all the targets. So the key here is that, okay, taking that bird in the hand, selling half at a double also gets your risk capital back. So that you think about if you invested $1,000, you turned it into 2,000 on a doubler. By selling half of that 2,000, getting that original $1,000 back into your pocket, that should not just financially but psychologically free you up to be able to let the rest of the trend run, give it a chance to keep going. If you don't give those trades a chance, you're cutting your profits short. That's the wrong thing to do. You want to cut your losses short, let your profits run. So from this principle, you say, okay, look, this is all about, making sure you're using the right strategy and the right mindset. I talk to some new subscribers sometimes that'll come in and say, oh, you made that big gain. I only took a 30% gain because I thought 30% gain on a stock, that's pretty good, right? They didn't want to, don't want to be greedy. Bulls and bears get rich, but hogs get slaughtered, right? But this principle is that, look, the institutions are the ones who are driving the train here, not you and me as individuals. So when they start to pour on the gas here, when they see these things going, they can't build their position all at once. When you're moving billions around, you oftentimes have to sort of tiptoe into the pool. If you're the 800-pound gorilla, if you did a jump into the middle of the pool all at once, it'd be like cannonballing it all out. The water would be all gone, right? They'd pay a lot more to rush in too quickly. So bottom line is that they want to ease into these trades as they get proof that they're working. Some of these, this one took a little bit longer. It took a whopping 22 trading days, just over a month, to get to our double and quadruple targets. This was support.com. SBRT was a symbol. And this was a late July trade, actually. We're about that time of year again. This is a previous year. But you look at this and you say, okay, look, we're getting our signal. It's telling us, okay, look, this thing's starting to break out right in here. And then it's officially closing above there over the next day or two, getting through that resistance. We said, okay, buy on the open the next morning. Well, it gapped up. It gapped up like a full half point, almost a full point, from like 7.5 to 8.5. We paid 8.5 for it. And then initially we were wrong. Initially it drifted on back down. You see how it dropped back off to about 7. We're down about 20% over the next 4 days on that stock. But look what's happening. It's going through what I call a retest, the retest of this 100 line here, which again, you get all those oscillators and techniques when you get signed up as a subscriber. But the idea is that at that point, it should hold. And you see it did. It kind of hung around for a few days, then started to grind back up. So that's a normal kind of a pause after the first breakout that can happen. You say, well, why don't you wait to buy the retest? We've done that at times before. And you get left again missing some of the best movers that don't retest, right? So the idea is that just know that's part of the game. Know that, okay, by not overcommitting your capital, you're saying, look, this train's left the station. Sure, it's pausing a little bit, but we don't want to miss out on the ones that just take off without us. And then you see what happens is it starts to grind back up. And by about the, you can see it by about the 21st day, it's getting up to our first target, which is 8.5 times 2, $17, right? So there's our first target at 100%. The next morning, look at what happens. It goes and it gaps crazily from about $20 up, opens at like 37 and a half. Our target obviously was like 34. So we made more than our 300% target. We're cashing it out off of that open at 351% gain. You say, oh man, it went from 37 intraday, it hit over 55. And I say, yeah, but it closed back at 27. We were out 10 points higher than where it closed later that day on that red reversal candle. You see the next day it got to 42, came back, finished about 37, drifted off to 32. Then the day after that. The point is, look, you get your target profits, you take the money and run. Our research shows that, sure, some of these can go on to even bigger gains than 300% profits, but a number of these get that extended at that point. You see our oscillator is going up here into the 600 to 800 range. You're getting very extended at that point. Okay, the retest back to 100 would be a long ride down. So the risk reward doesn't favor that trade anymore. We take the bird in the hand and we move on to the next trade. You've probably heard of plug power in this whole electric vehicle trend that's been going on. Going to need a lot of electricity to supply all these electric vehicles, right? Well, plug power, plug is a symbol, was one that gave us our signal here when the stock was trading at about 18.47 was our official entry. You can see slow grind up. It took about 6 weeks to get to our first target from 18.5 up to about 37. So up here near 37, 36.88, if memory serves me right. You say, okay, look, we took 100% profit and 36.92, I guess it was. And you say, look, from this perspective, you'd say, okay, we're out. And then from 37 almost, it drifted down to 30. And I remember seeing the subscriber email. It's like, man, we should have sold the whole thing up there at 37. It's down to 30. I said, relax. You have a free trade. It hasn't even paused. And yeah, it's just basically, it hasn't even come close to a retest. Give it a chance. And then from 30 over a period of about, you can see 6 trading days, it went from 30 to 74, more than doubling and more than quadrupling our position. We hit the full quadruple, a 300% gain in a total of 9 weeks. Okay, just over 2 months. So, at that point we're out. As you know, that was an example from the past where we were close to the end of that sort of meme stock thing going on. This wasn't a meme stock per se, like a GameStop or an AMC, which we traded those too. But the bottom line is that it's about finding the sweet spot. When the market is favoring those type of stocks, you're going to be in to ride that move. When it's not favoring those stocks, you're out. We're a long way away from getting any signals on those type of meme stocks right now. And so the point is that you can't be like, I never trade those, or I never would trade a stock that doesn't show that it's making a lot of money or whatever. It's like, you have to realize the market's going to reward different things at different times. Your job as a trader and investor is to have a system and method to take that money out of the market when the market is favoring that particular stock. If it's not favoring it, you don't buy into a story and say, well, it's a quality company, it's down right now, on the stock, but I think it'll bounce back. It's saying, no, follow the leaders, follow where the institutional money is moving. When you do that, you will be much better off in your portfolio to get a piece of that. It's like following the whales and the sharks in the ocean, right? We're the smaller fish that are riding along behind them, not in front of them, but behind them, to say, look, okay, just ride along to where the next meal is, the next opportunity is, right? So the institutions are helping to drive that opportunity, and your job is to get in tune with where they're going. Follow the whales and the sharks, and you'll be better off. Okay, so sure, winning trades are wonderful. It's a lot of fun trading this method over time, but it really is the compounding that makes this strategy so unique, because we're not buying, there's a lot of big name stocks that are 100, 200 or more dollars a share. Our experience is the stocks at 50 or less, and actually even better, the stocks at $10 or less are going to be the ones that give us the most bang for our buck with this method. It's not that we can buy more shares, it's that they are the ones that have the potential to move a lot. So, obviously, even if you were trading per what we showed you before with getting 2 shares of each stock, even if every one of our 25 stocks was at $50, which they won't be, 2 shares would be $100 a trade. As little as $2,500 could get you started as an investment portfolio. And that's at the absolute maximum. A lot of times you could obviously start with even less than that. So let's let's look at some more examples of the kind of names that we like to trade. This was a name, Atossa Therapeutics, ATOS. It was, when we got in, we bought it at $4.15 a share. So this was a retest trade. It was coming in for the retest this day before. And you say, well, why didn't you buy it on the breakout like you're just preaching? Well, there's a point here when it's more than 200, especially over 250. This one was over 200 when we got our confirmed buy. That's a little bit extended. It's a little bit of a risk factor. You can see the stock when it closed above all that resistance was trading about $6. If we had bought the next bars open, we'd have paid about 6.5 for it. Instead, we said, look, the risk is too high of a retrace. We're going to wait. And even just that next day, it dropped from 6.5 to about 4.5. And then we're in there buying it right off of the open here, $4.15. It didn't take off the very first day. I think it closed that day at like 387 or something. We were down a hair that first day at the close. No big deal. But you can see then it grinds back up. What do we need to happen to get our first target? 415 times 2, right? That's a double. $8.30. You can see it tagged 830 here the day before the peak, and then it peaked out at about 9.5 and then started coming back down. So you saw half of it at $8.30. You doubled your money in 10 trading days, and then you follow our trailing stop rules on how we protect our profits to not let too much of it slip away on the rest of the position. Even if the other half went back to zero, to a no gain or loss, to a break even, if you sold half at a double, half at zero, you'd be at a 50% gain on the whole position. That'd still be very healthy. So another one that fit that kind of retest model was this stock, Super League Gaming. You probably heard of esports and e-gaming. And you see here, SLGG was a name that my scans picked up. I'd never heard of it before. Again, this one was, the setup point was here, and then the breakout was on the close the next bar. And again, that was too extended over that 200 threshold. And you can see, though, I said, okay, look, when it came back in to give me the retest, we were in there buying it at $5.25. First day it's down to maybe 475. We're down maybe 10% initially. If you panic on these, you can lose a lot of bigger picture opportunity. I'd hate to see you down 10% when our rule said we should still hold it for now. We guide you through and tell you, okay, and email alerts and text follows to your smartphone after the close, this is one that we're still holding, or no, this is one we're getting rid of at the next day's open. This one we were still holding. We need to go from 5.25 to 10.5. Look at where it peaked. It peaked at about 11 here, just about 10 days later. So you see that this is the kind of thing that sell half at a double, give it a chance to keep running. If it doesn't, no big deal. We'll still make money on the whole trade, even if the other half gapped down to break even. We're in a good position. Even if the other half went to nothing, we wouldn't lose on the trade. It's a guaranteed break even if the other half went to zero, which on a stock, we'll have a lot of time to adapt way before that happens. As you can see, these high momentum stock trades have been powerful for us, but I'm going to show you how they can be powerful even quicker. Some of these will get their targets, like SENS, Sensonics, got its target the very next day. So we ended up, getting our signal, across our 100 threshold, and then closed above it. Wasn't too extended. It was getting close, but it wasn't quite at that 200 level. So we said buy the next morning here. We paid $1.60 per share. Pretty cheap stock, right? $1.60. By that day, it was up near 3. You said, why not close it that same day? You're almost at a double. I said, no, follow the rules. Target 320. We sold it out the next morning here at 330 for the 106%. Okay. So there's our exit. You see it went a little bit higher intraday and then reversed back down. Came back towards the low 2s over the next couple of sessions. Selling at 330 was the right thing to do on half of the position. So then it grinds a little bit higher after that. But you can see that the idea is that, look, taking some money while the market makes it available to you is a very wise idea. And you see, like, here's a great case with LEDS, kind of a tech name here where, again, not a household name. By the way, what I want to show you on this chart is that, look, the first setup was happening off of this high, but you see what happens when it comes back down without ever confirming. We just turned it off. We say, okay, that setup didn't work. Next setup happens right after we turn it off, right off of these highs. Again, it doesn't get going, turn it off, wait for the next setup. The next setup is happening right off of this high. And you can see 3 days later, it's closing above there. So the third time was a charm. And so we're in there buying the next morning's open right off the market open there at 12.5 bucks. And you see that it pauses a little bit, dips just under 12. And then what do we need 12.5 to turn into? 25 on the third day. We're selling half of it at our 100% gain 3 trading days later. So the beauty of this is, and you see this one does then retrace from 25 back into the high teens over the next couple of weeks. So when that happens, you don't sweat it. You say, look, it's still well above its thresholds here. You've got a free trade, give it a chance to ultimately keep going, even if you have to endure a little bit of retrace. If it retraces too much, we will get out. So like when an EV name that I'd never heard of when Tesla was roaring, along with a lot of these other ones here, was this Electromechanica Vehicles, SOLO is a symbol. It's obviously an EV play elsewhere, an international play, if you will. You can see, sure, it looks like the stock's starting to get ready to break out, but you can see that the official breakout is not confirmed until we get this first high eclipsed with a future close, which happened there this next day. And so we ended up buying it at around 6. You can see it got to the 12-ish area, hit over 13 actually 4 days later. So this was one that I recall did come back to about break even on the second half. So we only made 50% on the whole trade. That happens sometimes. But selling half at a double 4 days later gives you incredible flexibility to see if it's going to turn into the next Tesla or not. Aptivo Pharmaceuticals, APVO. You can see this monster surge where the stock comes out of nowhere. Our setup point happens just under 20, and the next day it closes right at 20. We're in there buying it around $21 that following morning. I remember it well because it was a Friday. It went from like 21 to 30 intraday, closed back at about 25, 26. It's about maybe 20% of the stock. And you see, we're saying, look, it's got to go from 21 to 42. After the close on that Friday, they had some news that was hitting that had the stock up by the next Monday morning at 50 bucks a share. So our 21 turned into 50. We made 142% on the first half of our position. And now we've gotten more than a free trade out of that first half of our position. And you see, sure, it reversed back down later that day, then popped back to test 50, then settled back down. Again, point being that, regardless of what happens at that point, you've got a nice winning trade on your whole position. So when you sit back and imagine for a moment, how would your life change if you suddenly had access to this same system that found those big winning trades, sometimes in a matter of days? But even if it takes 2 or 3 months, it's an incredibly powerful thing to turn into doubles and sometimes triples and quadruples. What would you want to do with that newfound power, right? It's like that sort of superpower that we all want in our trading and investing, to say, look, when you've got a system this powerful, it's all about then making sure that you can execute it. And so that's why it's so important to me to say, I don't want you missing out on trades. That's why we send out an email and a text alert follow-up. And we guide you through the whole process here of, okay, what you need to do when you get an entry or an exit signal to get in or get out, making sure that you don't hesitate. You can place your trades to get in or get out that night or the next morning before the market opens. So it's really clean and simple, and you don't have to be spending a lot of time on your trading. You don't have to be screen watching. So a reminder on the historical performance on stock doublers is, okay, a $10,000 portfolio, you can see here, turned into over $73,000 over about, like we said, a little over 5.5 years, from January 1st of 2017 through today. So you look at that and say, okay, stock's priced at 50 bucks or less per share. And you can see in this case that that led to a $63,000 plus profit over about 5.5 years. That's assuming that you don't put in 10% of your account, you only put in 4% of the account, because there are times where we will have all 25 of our equity positions invested. There are other times like now where we've got a much more focused portfolio because of the nature of the markets, right? So it kind of does its job for you in guiding you through this process to say, you know what, we want to make sure that you don't get yourself in a position where you end up, taking on too much risk or missing out on other trades that we call out because you've invested too much into the earlier trades. So, even if you were doing that, I would tell you to cut back your earlier trade sizes and allocate more into the new, so that you can allocate to where you get the new trades in. Always believe that your freshest trades are your best trades, in the sense that, it's a window of opportunity. When you've got a window of opportunity like this, you say, look, the idea is that when the window's open, the door's open, you want to be able to walk through it. You want to be able to take advantage of it. You want to be able to participate. But when the door and the window shuts, you don't want to force yourself into that, bang your head against the wall or break the window glass, right? It's like, no, that's now a closed situation that you don't want to participate in. So you have to think of all your trades and investments kind of like that. Like, there's either an opening, where you've got an opportunity, or if the door slams shut on it, then you just say, look, I'm going to pass on. I'm not going to force that idea. I'm not going to hope that I know more than the markets. It's like, if that thing says it's a violation, it's an exit, then you blow it out, you move on to the next opportunity, or you wait in cash while you're waiting for your next opportunity. So cash is not trash here. Cash has a very valuable place for us in keeping us relatively stable while the market's been dropping here in 2022. That gives you the position when we do start to get more signals, which we're starting to get some fresh signals now. We just had 2, as I mentioned, that are available for you now to get into, that we just called out yesterday morning's entry. So these are fresh. You say, okay, you can get into those when you get signed up. We'll tell you how you sign up here in a minute. But the idea is that, you look at this and say, okay, clearly we have an opportunity here to really focus on kind of the best of the best situations. So, and I know David gave me a little bit extra time here. So what I wanted to do is, before I get into the offer, I want to also mention that I'm giving you kind of an extra bonus here, not just my stock doublers trade alerts, but I'm also going to give you my stock leaders strategy. So stock leaders uses a type of a band. It's a flexible band. It says that, look, a stock should normally trade within these bands. When it doesn't trade within the bands, it starts to break out outside of the upper band. That tells us that something unusual is going on. I'm going to actually throw that in as an additional free portfolio on top of the stock doublers portfolio that you're getting access to when I get you that information on how you can get signed up here in a minute. But stock leaders, you say, okay, so that's blue chips. That's like the S&P 500. It's not going into the cheaper names that you may never have heard of. It's saying, no, all these names. We've had success in 2022 with the oils. I think Marathon's been our biggest winner in 2022. We also cashed out an AMD, Advanced Micro Devices chip stock, at a healthy win earlier in the year. So it's one of those things where, these stocks are priced up to $150 a share. So of course that allows you to trade the Apples and the big tech names to go with. Of course, like even Google and Amazon with their splits are down into the low 100s. So it gives you the ability to trade those kind of names and take advantage of those blue chips. Over 21 years of data that we've have out there on this one, going back to September of 2000, something that was available even back then, 2 decades ago. You can see, again, this portfolio, we said we're not going to do more than 10 trades open at once, since it's the top 10 of the S&P 500. So literally the top 2% of the S&P 500 at any one time that we could be owning on those best of the best stocks. And it's something where you say, okay, look, with that kind of a focus on a $10,000 account would have grown to more than $226,000 over 21 years. So if you average it out per year, you're like $9,900 a year. Again, assuming no commissions, because we're at no commissions now. And knowing that past performance doesn't guarantee future results, but knowing that the principle is, look, you can take advantage of this by just being slow and steady winning the race. So if you think about, if you had a $10,000 account allocated to stock leaders, that would mean no more than $1,000 goes into each trade at the start. But then as you grow it, yes, it compounds. Obviously, if you're up to $226,000, what's your next trade going to be? How much you're going to put into your next trade on a 10% allocation? From about $22,500, right? 22.6 thousand. So the idea is that 10% of that, 226. So the principle is, you want to focus yourself on how to let that compounding work for you. But also when it's time to get out, we will get out. We won't just hold 10 positions no matter what. If the market's not supporting it, then we'll wait. So it's a really beautiful thing to really focus on these bands as well. And again, when you become a subscriber today, you'll get both of these systems with the specific rule sheets, the specific data, the parameters that you need to follow, and it's basically some training and education, what we call strategy sessions, to help you get started and know exactly what you need to do to start taking full advantage of these opportunities. So let me tell you how you can take advantage of this here today. It's not one, but actually both stock doublers and stock leaders portfolios. You'll get 12 months of trade alerts from our stock doublers alert service. Anytime we've got a new signal, it could come after the close on any day. And if you bought it each month over 12 months, that would cost you more than $3,500 because we've got a $297 monthly list price on that. 12 months of trade alerts on stock leaders as well. I'm throwing that in as an extra bonus. That's actually a $197 monthly list. That's a $2,300 plus value on that one. And you look at this and say, that if we were going to do an extra bonus for you, I'm not going to just give you 12 months of each. I'm going to BOGO it. If you buy 1 year of each, I'm going to give you 2 years of each. I'm going to give you 12 free months of both. And you look at that and say, holy cow, I'm getting 24 months of access to both of these portfolios. I'm going to give you weekly video training at the end of the day every Monday to tell you what I'm expecting for the week ahead on both of these portfolios. You'll get my stock doublers rule sheet and settings all laid out for you, specifics, as well as stock leaders. You can follow along on your end from your computer and cell phone. And then, of course, you get a dedicated email to me and my analyst team. And you start adding up all the value of this 2-year package, $11,856. I'm going to bring it down dramatically for you. I'm going to say, you know what? You can get started today with the first of 4 payments of just $297 a piece. So you make 4 payments of $297 a piece. That's $1,188 to basically say it's like almost 90% off of that $11,856 total package value. 4 payments of $297. The other great thing is that, so where do you go to get that? You go to members.bigtrends.com/stock. Okay, that's an easy one to remember. So when you go to members.bigtrends.com/stock, I'm going to walk you through that page. This is a really simple one here in just a second. But you could pay the full $1,188 up front, but we actually basically have a 0% interest installment that where you can say, hey, 4 payments, 1 each month for the next today, and then 3 more after it. And say, look, it keeps it real simple, where you can lock in 2 years of value, almost $12,000 total package value for less than $1,200, 90% off. And so you have the single payment option, but if you just click this box here, I want to show you when you go to that page, this is what it looks like. You click that box. And what's great about this box here, let me maximize this so I can show you how specific we are. Sure, we take your credit card information securely, and you can do that, or you can also go to this yellow button at the bottom, PayPal, and do a PayPal setup for that payment. But it tells you, okay, you paid $297 today. If you try it over the next 30 days, you don't like it, I'm not going to commit you to making the other payments. You can say you can basically try it out for the next 30 days, $297. If you're not seeing the value in your subscription already, then you don't have to continue the payments. So that basically what would happen at that point is that it would be treated like you had bought a 30-day subscription, and your payment would expire. Your subscription would expire 30 days after your last payment was received. Okay, so that's if you don't make the payments, and you're only getting 30 days at a time access. Heads up on that. So this is why you should want to lock in the full value, having made the first payment to make the other 3. So you now have 2 years of access. When we said, hey, typically a monthly cost is $297 just for stock doublers. So it's like buying 4 months of stock doublers, but actually getting 24 months, an extra 20 months, and getting 24 months of stock leaders thrown in as an absolutely free bonus. So you're getting both. It just shows stock doublers here, but I'm throwing in stock leaders as well. So you're getting not 1, but 2 portfolios. Stock leaders is the blue chips, stock doublers is the high growth, high momentum names, getting you on the next future growth name that you've never heard of. Sometimes I've never heard of these names as they pop up on my scans. That's okay. The one that I made just the other day, I'd heard of one of the names, but the other one was fairly new to me. So it's one of those things where it's like the technical scan tells us big institutional interest here. You want to be on board that as well. So we also give you our 800 Big Trends number here. If you can't remember this toll-free number, just remember 1-800-BIG TRENDS, and you can email us clientcare@bigtrends.com. And I know David gave me a few extra minutes, so I want to make sure if there's any questions, pop in your questions. I'll seek to also get those answered here for you as well. But bottom line here is to say, okay, look, when we're looking at this, we're saying we know we need to make sure. So Terry said, what's that bottom indicator? Okay, that's an oscillator that I developed that shows me how overbought something is against its long-term trend. Okay, so what does that mean? It means that you want to own stocks that are very overbought and going more overbought, that the institutions can't get enough of. Overbought, this is the biggest misnomer, and if there's one thing I would have you take out of today's presentation, it's that overbought is not a bad thing. In fact, it can be powerfully good. If the institutions want to buy, they're going to keep buying at almost any price to say, we know there's good news coming on this stock. We want to be on board. We want to keep building our exposure to it. We don't want to freak the market out and buy, 10 times its daily volume and all at once, right? We want to kind of ease our way into it day after day after day. So what does that lead to? It leads to a steady stream of buying power. So that's the kind of name that you want to be on. You've seen these stocks before where they just keep going and going and going, kind of the Energizer Bunny stocks, right? They just don't stop. And that tells you that the institutional volume continues to pour it on, continues to be good. You need your portfolio to be in those kind of names that the institutions have some insight as to what's happening. I don't know about you, but my belief is that somebody knows something about what's coming up with that stock's earnings, with that stock's future growth potential. It's amazing to me when I go back and look at some of the names that I've seen that were kind of early growth stocks. Like I think back to Taser, for example, like it's now called Axon, AXON. But like Taser, I was at Fox News in New York City in their green room getting ready to go on for a share my views on the stock market with Neil Cavuto. And the guys who founded Taser walked in these long black leather trench coats. It was about the time of the Matrix movie. And I thought, boy, this looks like a lot of hype. They're in here really hyping this thing up, saying how they're the high-tech future. But obviously, if you go back and look at how well that stock's done, they've been very right. The stock's been a massive winner over a couple of decades, right? So when you see this name like a Taser pop up early on in my scans, like it did back in 2004 for me, I got a piece of it then and basically said, look, if you watch how that thing can grow, that the institutions know something. Somebody knows something, right? So it's not just hype. These things, there's a future wave of growth happening in these types of names that Stock Doublers picks up. And then, of course, in the blue chip portfolio for stock leaders, you'll also get, kind of the best of the best performance out of where the money's flowing into those bigger cap blue chips as well with the stock leaders portfolio. So, like I said, members.bigtrends.com/stock. It gets you access to not 1 year of both stock doublers and stock leaders. It gets you 24 months. That's 2 years access of stock doublers and 2 years access of stock leaders. So you're getting both stock portfolios for the next 2 years. That's going to take you past the middle of 2024 as your expiration date, July 21st of 2024, 2 years from now. And as we showed you, when you go to that page, make sure you click on, unless you want to pay the one-time payment and be done, just get started for the $297. You don't have to pay the full amount up front. $297 broken into 4 equal payments, $297 a piece. You'll pay that, and by the time that you're done on October 19th as the last of the 4 payments, that will then update that your subscription will have the full 2 years access expiring July 21st of 2024 to both portfolios. So it's really powerful stuff. It's something you don't want to miss, and you're going to get all the extra bonuses. You're going to get the rule sheets and settings. We do ask that you review our terms and conditions, which are spelled out here. Like I said, we're on our 23rd year since I launched BigTrends.com back in 1999. So it's one of those things where we want you to be fully aware of the terms are very evenly and clearly spelled out of when you subscribe. This is how this works. And this is what you can expect. If you've got questions, here's where you email, here's where you call, here's what you can expect. How many trades do you get on these portfolios? It depends on the market environment, but we could get as much as 100 trades in stock doublers in a year. We could get as little as 40 or 50 trades on stock doublers in a year. It doesn't matter to me about the quantity. It matters to me about the quality. Remember, if you make one of these stock doublers trades where you invest $1,000 in, say you're investing $1,000 in per trade on stock doublers, and let's say it gets to both of its targets, the double and the eventual quadruple, the double on the double, that averages you a triple on your money. So 1,000 turns into 3,000. That's a $2,000 profit on one stock doublers trade that hits both of its profit targets. Okay, we're not going to expect that we have to have a ton of those, but just one of those in a year practically doubles your return on your investment. Your under 1,200 is worth you've got an extra $800 of profit on top of that on just one of those stock doublers trades where 1,000 turned into 3,000 on when both of its profit target objectives are reached. So the point of this is it doesn't take a lot to give you a tremendous bang for your buck. And you're not just getting 1 year's bang for your buck, you're getting 2 years bang for your buck. So every extra one of those that hits is like extra gravy and extra return on your investment that you make. By the time that you're all in with us here, you've invested $1,188, whether you do the $297 payments a piece, 4 payments of $297 each every 30 days, today and then the next 3 months. We spell out that when those dates would hit your credit card, so it's really clear. We take all the major cards, and of course, with PayPal. And PayPal is a feature, even buy now, pay later feature as well. So if that's a problem for you to get started at the $297, you can even consider looking into that buy now, pay later functionality that PayPal has now. But the point is, the biggest goal I have for you is to get started. If you're not satisfied with your trading performance, then get started. If you are satisfied, then obviously keep doing what you're doing and don't do anything else. So we get a lot of our students who will tell us, I've already got a good method, but then I like seeing what you're seeing to add to what I'm doing. So either it's a confirmation on whatever else you might want to run through when you get the next trade from us. And by the way, we've got 2 brand new stock doublers trades waiting for you. When you get signed up, you'll get my 2 new trades that you can take advantage of here today, right now. Okay, don't wait on these. Again, just one of those hitting its targets, like we said, can more than pay for your 2 years access to both of these programs here. So remember, one last time, and then I'll hand it back over to David here. But basically, you go to members. It's not a www link. Notice it's members.bigtrends.com/stock. We want you thinking like a member of the program, and basically realizing that you're going to get this member site access as well, where you say, okay, you can go in, you can see what's been done in recent times. You can see my recent training alerts. You get your access to the rule sheets and settings via your members site as well. So you get a lot of extra bonuses as part of this subscription. It's not just calling out trades, it's teaching you how to find these for the rest of your life. When you learn this stuff, folks, you're going to say, man, I can't believe what I've been missing. I thought I should focus on Apple and Microsoft or whatever. And it's like, no, we want you on the next really monster growth leaders in stock doublers. And of course, the leading blue chips in whatever sector within the S&P 500 within stock leaders. 2 years access, pay one time for $1,188 or break that $1,188 into 4 zero interest payments of $297 each, one today, and then try it for the next 30 days. Keep it going when you see how good it is, or if it's not for you, you don't have to keep it going after that first $297 payment to get you started. But I think you're going to want to lock in the full 2-year value. And of course, what I believe is actually a monster bullish phase coming up for equities into 2023 and beyond. When you think about, you say, oh, well, you don't be too Pollyanna. We know there's high inflation. We know there's all these problems and fears. We know there's a potential recession that we're in the midst of. The best time to buy stocks, folks, is when you're in the midst of all that bad news, when you're in the midst of that recession, especially as we see the turning point on it. We said at the beginning of this year, when I did my 2022 outlook, that it was seasonally going to be a challenging year, and that the seasonal bottom would likely come ahead of the midterm elections, and we're not that far from that now, right? The midterms are in early November. So when you're saying, I'm already starting to see buy signals coming out of this kind of bearish phase in these leading equities, this is a great opportunity to get you started and start positioning you for big opportunities ahead in the next year and 2 years with this 2-year special package. So I don't want to take any excess time away from our next speaker. So I want to make sure I hand it back over to David, but I want to say, David, thank you for having me. Folks, make sure you go to members.bigtrends.com/stock. And that's going to lock in this awesome payment plan to get started for just $297 today, and lets you lock this in over 2 years when you just carry that forward across the 4 even installments. We're all about knowing we got to provide you great value to make sure that you see a great return on your investment with Big Trends. That's why we've been around for 23 years and growing, and want to help you grow too, grow your portfolio and grow your stock trading and investment knowledge with this very unique system. And you'll get the indicator settings, the indicator, what it's made of, and how you can plot it on your end as well. So thanks so much for having me, David. Always a pleasure. And I'll hand it back over to you to get ready for our next speaker.